Then for variable overhead variances, it's very important that you identify upfront in the question whether the overhead varies with units or hours. Because if the variable overhead varies with units, you will only be able to calculate an expenditure variance. On the other hand, if it varies with hours, you'll be able to calculate both an expenditure and an efficiency variance. Now you can work through the journal entries and the lecture examples for variable overhead variances. The calculations are very straightforward. Then for fixed overhead variances, and please note if labor is a fixed cost, then all of your labor variances are going to be calculated in exactly the same way as your fixed overhead variances. Now, it's important to identify upfront in a question whether the company makes use of absorption costing or variable costing, because that is going to affect the calculations that we can perform. First, if the company makes use of absorption costing, the logic that we follow is we always start with the actual when we are calculating variances. Now you'll see, because we are no longer dealing with variable costs, the logic changes a little bit, and we don't break the actual down into the actual price and the actual quantity, or the actual rate and the actual hours. We just look at the actual cost in total, and we look at the budgeted cost in total. So the variance calculations look a little bit different because we are now dealing with a fixed cost instead of a variable cost. So you still start with the actual, we follow the same logic. Then the difference between the actual and the budgeted amount gives you your expenditure variance, and the difference between the budgeted amount and the absorbed amount gives you your volume variance. And please note, guys, that this calculation is exactly the same calculation that we look at in our variable and absorption costing lecture, where we calculate the fixed overhead, expenditure, and volume variances. So this is the same as the variable and absorption costing lecture. The only difference is the volume variance can now be further broken down into a capacity and an efficiency variance. But I'm going to show you that calculation when we get to our lecture examples, and I'll also work through the journal entries with our lecture example. Please note, if variable costing is used, remember, with variable costing, we only include variable production costs in the value of inventory. Fixed costs are expensed in the period incurred. On the other hand, with absorption costing, we include both fixed and variable manufacturing costs in the value of inventory. So that's why we calculate an absorbed cost. Remember, this is to comply with IAS 2. First, we calculate an allocation rate, which is based on normal capacity. Then after we've calculated the allocation rate, we calculate the absorbed cost, which is the allocation rate multiplied by actual production. Now, if the company is using variable costing, then they won't be allocating fixed overheads to their inventory. So they won't be calculating an allocation rate and an absorbed overhead. So that means if variable costing is used, we don't calculate a volume variance because we won't have an absorbed fixed cost. If variable costing is used, we can only calculate an expenditure variance. All right, so if variable costing is used, only an expenditure variance can be calculated. And the reason for that is because fixed overheads will not be included in the value of inventory. So in other words, we don't have an absorbed overhead, so a volume variance can't be calculated. Instead, what happens to your fixed overheads? They are expensed in full in the period incurred, and you can see that with the journal entries. Fixed overheads are treated as period costs when we use variable costing, and the actual cost is not included in the value of inventory, but instead expensed in full in the period incurred. So you just debit the fixed overhead expense and you credit creditors or bank. All right, let's go and have a look at the lecture examples. The following information relates to Thornhill Limited. The standard fixed overhead cost per unit is 30 Rand, and it should take 6 machine hours to make 1 unit. So using that information, we can calculate the standard rate per machine hour. The standard cost per unit is 30 Rand, and it should take 6 machine hours to make 1 unit. So the standard rate per machine hour is 5 Rand. You are told that fixed overheads are allocated to products using machine hours. So if fixed overheads are allocated to products, that means the company is using absorption costing. So if absorption costing is being used, we'll be able to calculate both an expenditure and a volume variance. You are told that normal capacity is 810,000 machine hours. All right, so make sense of the information that's been provided. You've been given normal capacity, you've also been given the standard rate per machine hour. So that's enough information to calculate the budgeted fixed overhead. Because the standard rate is 5 Rand per machine hour and normal capacity is 810,000 machine hours. So that gives us a budgeted fixed overhead of 4,050,000. And you can prove that. How do we calculate our fixed overhead allocation rate? We take the budgeted fixed overhead and we divide by normal capacity. That's to comply with IAS 2. So, we calculated that the budgeted cost is 4,050,000, and we were told that normal capacity is 810,000 machine hours, so that gives us an allocation rate of 5 Rand per machine hour. Now remember, in step 1, we always calculate the allocation rate. When we are allocating fixed overheads to products and using absorption costing, in step 1, we always calculate the allocation rate. In step 2, we then calculate the absorbed fixed overhead. But before we can do that, we can't work with an allocation rate per machine hour. We need this to be an allocation rate per unit. So we need to multiply by the standard number of machine hours required to make 1 unit, and that will give us the allocation rate per unit. It's 30 Rand per unit. So obviously all of this information has been provided, so you didn't have to perform these calculations, but it's important that you understand the logic behind the calculations. So then how do we calculate the absorbed fixed overhead? We take the allocation rate and we multiply by actual production. So you were given the actual information, you were given actual production, the actual fixed overhead cost, and also actual machine hours. So actual production is 200,000 units, which means the absorbed fixed overhead is 6 million Rand. All right, and in this question, first in part 1, you need to calculate all possible fixed overhead variances in as much detail as possible. All right, so how do we calculate these variances? We always start our variance calculations with the actual cost. Then, the difference between the actual and budgeted cost will give you an expenditure variance. And if variable costing is used, you can only calculate an expenditure variance. So our calculations will stop there. However, this company uses absorption costing. So we can calculate an absorbed fixed overhead. We have already calculated the absorbed fixed overhead. And that means if we can calculate the absorbed fixed overhead, we can calculate a volume variance. So the difference between the budgeted fixed overhead and the absorbed fixed overhead will give me a volume variance. Now just be careful. In this question, you were told to calculate all possible fixed overhead variances in as much detail as possible. So that means you shouldn't just calculate the volume variance in total, but instead it should be split into a capacity and an efficiency variance. And to do that, we need the standard rate multiplied by the actual hours. So this will give me a capacity variance and this will give me an efficiency variance. All right, so let's have a look at the calculations. First, in order to calculate the expenditure variance, that's the difference between the actual cost and the budgeted cost. So you were given the actual fixed overhead, and we calculated the budgeted fixed overhead to be 40,050,000. So this variance is obviously unfavorable because the actual cost is higher than the budgeted cost. Then, I have included the calculation for the volume variance because I want you to understand the logic behind the calculation. However, please note the calculation is not required. It's just been included for completeness sake. In terms of the required, you needed to calculate the variances in as much detail as possible. So you should jump to the efficiency variance and the capacity variance, and then the sum of those two will give you the volume variance. But obviously, I'm now just including this for your understanding. So the volume variance is the difference between the budgeted cost and the absorbed cost. So we have the budgeted cost above. You can just bring that down. And we did already calculate the absorbed cost. It's 6 million rand. All right. And this variance is favorable because the absorbed cost is higher than the budgeted cost. So that means that they actually produced more units than what they budgeted to produce. So because this is a volume variance, we look at the volume in order to determine whether the variance is favorable or unfavorable. If the absorbed cost is higher than the budgeted cost, then they actually produced more than what they budgeted to produce, and the variance is therefore favorable. If you further want to look at the logic, remember, as an alternative, we can calculate this volume variance by looking at the difference between the budgeted and the actual production. So, we know that they actually produced 200,000 units. We don't know how many units they budgeted to produce. However, we do have the total budgeted cost, and we have the budgeted cost per unit. So if we take the total cost and divide by the cost per unit, that will give us the budgeted production in units. So first, I calculate the budgeted production. So they budgeted to produce 135,000 units. They actually produced 200,000 units. So they actually produced more than what they budgeted to produce, and that's why this variance is favorable. However, if we want the rand value of the variance, because we've just calculated the variance now in units, if you want the rand value, you need to multiply by the allocation rate per unit, which is 30 rand. And you can see that ties into the calculation above. All right. So that's been included for completeness sake. You didn't need to perform the calculation, but obviously make sure that you can perform the calculation. All right. So in our variable and absorption costing lecture, in step 1, we calculate the allocation rate. In step 2, we calculate the absorbed fixed overhead. In step 3, we calculate the expenditure variance. And in step 4, we calculate the volume variance. And all of the calculations are performed in exactly the same way in both your standard costing lecture and also the variable and absorption costing lecture. The only extra calculation that we have now is we need to calculate the capacity variance and the efficiency variance. So, the capacity variance is the difference between the budgeted cost and the standard rate multiplied by actual hours, and the efficiency variance is the difference between standard rate multiplied by actual hours and the absorbed cost. So let's perform those calculations. So the capacity variance is the difference between the budgeted cost, which we have already worked with and calculated, and the standard rate multiplied by actual hours. Please note, when we talk about a standard rate, we are talking about a rate per hour. We are not talking about a standard cost per unit. So we want the standard rate, which is 5 Rand per machine hour, not the cost per unit. And think about it logically. You are taking the standard rate of 5 Rand per machine hour, and you are multiplying that by the actual number of machine hours. So you obviously can't take the actual hours and multiply that by standard cost per unit. That doesn't make any sense. So if we are working with actual hours over here, the actual hours must be multiplied by a rate per hour. And please note the actual hours just come directly from the information provided in the question. There's your actual machine hours. So that gives you the capacity variance. Now, to determine whether the variance is favorable or unfavorable, you can see I've just broken this down a little bit further. So we calculated this total budgeted cost by saying the standard rate per machine hour is 5 Rand and normal capacity is 810,000 machine hours. So that's how we calculated that budgeted cost. So you can see the standard rate is exactly the same. It's 5 Rand per machine hour. So we are comparing normal capacity to actual machine hours. Now you can see the company has failed to utilize their planned capacity. They should have had 810,000 machine hours. That's their normal capacity. However, the machines were only running for 750,000 hours. So they did not use the available capacity, and that means that this variance is unfavorable. So please note, when you are trying to determine whether the capacity variance is favorable or unfavorable, you want your actual machine hours to be as high as possible. All right. Now the opposite logic applies to the efficiency variance. So let's first look at the calculation. We start with the standard rate multiplied by actual hours, which comes from above. Just bring that down. This variance starts where the last variance ended. Then we need to deduct the absorbed cost. So we did calculate the absorbed fixed overhead. It's 6 million Rand. Right, so this is 6 million. Now you can see I've broken this down in a slightly different way just so that we can look at the discussion around why this variance is favorable. But you'll see if you calculate that, you come back to the absorbed cost of 6 million. So what I'm trying to show you with my breakdown is you'll see the standard rates are exactly the same. So what we are doing is we are saying if they actually produced 200,000 units, according to the standard, it should have taken them 6 machine hours per unit. So it should have taken 1.2 million machine hours. It actually took 750,000 machine hours. So because it actually took less time than what it should have, this variance is favorable. Because here we are looking at an efficiency variance. So we want the actual hours to be as low as possible. All right, so because the actual hours are lower than what they should have been, this variance is favorable. The machines operated more efficiently. All right, then remember you can calculate the volume variance by adding together the capacity and the efficiency variance. Just note we are calculating the difference between the two because the one is unfavorable and the other one is favorable. All right, and you'll see this ties in to the volume variance that we calculated above. So that's part one. We calculated the fixed overhead variances in as much detail as possible. Now we need to prepare the journal entries for fixed overheads. So first we need to record the actual fixed overhead that's payable. So we are dealing with the actual cost over here. You debit the fixed overhead control account and you credit creditors or bank with the actual cost. Now, the reason why you don't just expense the actual cost is because the company uses absorption costing. So remember, we are going to include this fixed overhead in the value of inventory. So it's taken to a control account. And then we're going to clear out the control account and include the absorbed fixed overhead in the value of inventory. So you'll see that's what we do next. We now transfer this to work in process. Remember, work in process is inventory. Inventory is made up of raw materials, work in process, and finished goods. So if we transfer this to work in process, we are taking the cost to inventory. And we are doing that because the company uses absorption costing. So we are going to transfer the cost to work in process and also account for the volume variance at the same time. So what you do is you credit the fixed overhead control account with the budgeted cost. So we took the actual cost to the fixed overhead control account. You are now taking out the budgeted cost. And we debit work in process with the absorbed cost. Remember, when we are valuing inventory, we use the absorbed fixed overhead to calculate the value of closing inventory. It's the absorbed fixed cost that is taken to work in process. All right, not the actual cost, not the budgeted cost, the absorbed cost. And the difference between those two amounts is your volume variance. And this is a credit to profit and loss because the volume variance was favorable. Now, there's still a balance sitting in this fixed overhead control account because we've only taken out the budgeted amount. So you now take out the rest. You clear out that control account so that the balance is 0. And we account for the expenditure variance. So the other side of this journal entry is your expenditure variance. And you'll see that does tie into the expenditure variance that we calculated. It was an unfavorable expenditure variance, and that's why it is a debit to profit and loss. So, how would this example change if variable costing was used instead of absorption costing? Now remember, when it comes to the variance calculations that we looked at in part 1, if we are using variable costing, we can't calculate an absorbed fixed overhead because we don't include fixed overheads in the value of inventory, which means if we can't calculate an absorbed fixed overhead, we won't be able to calculate a volume variance. So the volume variance is 0. There is no volume variance. We can only calculate an expenditure variance, and it's calculated in exactly the same way as we did when absorption costing was used. It's the difference between the actual cost and the budgeted cost. You can see it ties in perfectly. How would your journal entries change? Remember, when variable costing is used, fixed overheads are not included in the value of inventory. They are treated as period costs. So the actual cost is expensed in full in the period incurred. So if you have to look at the journal entries, you would just debit the fixed overhead expense. That's taken directly to profit and loss, and you credit creditors or the bank with your actual fixed overhead cost.